Hey there, Coach Julien here. In today's video, I'm going to talk about tech stocks that are well below their price target, 40% or more undervalued from their price target. I'm going to go through how I selected them and how I shortlisted these tech stocks. Hi, I'm Julien Regoli, CPA CMA, your finance coach. I teach people how to take control of their finances so they can reach financial freedom more rapidly. I firmly believe that you can do it on your own with some coaching. You don't need to be a math whiz, you don't need a finance degree. All you need to know is a few simple concepts and apply them. Have the discipline to apply those concepts and you can be well on your way to financial freedom. So if this kind of topic interests you, then subscribe to my channel, hit the bell button, and you'll be notified whenever I upload new content. Thanks for watching. So what I did here is the Y-Charts has this thing called the stock screener. The stock screener helps you find stocks and investments based on some key certain criteria. And you basically add different filters and it'll be narrowed down your search to a few stocks. So what I've done is I put in a price target here, price target upside of 39% or more. And the next thing is the PE ratio, the price over earnings, and this metric is a metric that allows to understand if the price of the stock is overvalued or undervalued in relation to its earnings. And for well-established companies, this is quite a relevant metric. So what I've said is I want stocks with a P ratio between 0 and 20. Then I looked at market cap. I want a market cap of 500 million or more. I want proof of concept. I want companies that are pretty solid. And so I established that I want market cap of 500 million and more. And finally, I want to see some revenue growth, and I use 37% revenue growth year over year. The screener gave me 13 different stocks here, and out of these I've shortlisted 3. The first one is a large cap, and it's called Logitech. So Logitech is a Swiss company. They make computer peripherals like mouse, headsets, cameras, and things like that. And since the lockdown, the demand for those kinds of things has gone up significantly. And lately it's been kind of smacked around, and we'll go through that. But let's just look at the fundamentals first. What I like about the financials, we start with the income statement. The blue line are the revenues, and the orange line are expenses. You can see that these are spreading away. The revenue line is spreading away from expenses. That means it's earning more profit. So you can see the net income here, the red line is going up. So I like the trending of the income statement. Balance sheet also, you can see the blue line, which are the assets, are spreading away from the liabilities, which is the orange line. And you can see that shareholders' equity also is going up. So I like the trending of the balance sheet. And from a cash flow perspective, I like it as well. It's got nice cash flow from operations. The latest quarter, it showed a cash flow from operations of over $1.2 billion trailing 12 months. Another thing I noticed with this one is PE ratio. So you can see that it's at the lowest level in 5 years. The average over the 5 years, it's been at 25.97 compared to 14.24 today. There's a section here that Y-Charts presents. It's relating to analyst coverage. It seems that there are 3 buy recommendations. 1 is recommending an outperform, 2 are recommending hold, and 1 is sell recommendation. The consensus, which is basically the average vote, is 2.286, which makes it an outperform. Very, very good ratings in general, and the price target is 122, which is 39% over the price today. So that's the upside that you've got on the stock according to the price target consensus. If we look at the cash flow here, we can see that the company has been buying its shares. This is really a good signal. $22 million there, 50 million the fourth quarter, and then 92 million in the first quarter of 2021. Almost $55 million worth of shares in the second quarter of 2021. It shows that management believes in the valuation of the shares. And second, when a company issues shares, the common shareholders become diluted. But when they buy back shares, the current common shareholders are enriched, so there are less shares outstanding. They're in a better position. I would tend to agree with the analyst up here that it's a buy recommendation. The second one is a mid cap, MKS Instruments. So MKS has a market cap of 8 billion, considered a mid cap. The description says it's engaged in providing instruments, subsystems, and process control systems used to measure, monitor, deliver, and control parameters of the manufacturing process. You can read up on it. If we look at the financial statements, I like the trending of the income statement. Again, the blue line, which are the revenues, are trending up. The gap between the revenues and the expenses, the orange line, is widening, and net income, which is the red line, going up. Balance sheet assets trending up. Shareholder equities are trending up. Cash flow is consistent. P/E ratio is sitting at 16.94. Historically, that is lower than average. Average 5 years is 22.9. Analyst coverage, consensus is 1.5, so even better than Logitech. So we've got 7 buy recommendations, 1 outperform, and 2 holds. The average is 1.5, considered outperform. The price target upside is 54%. And when I look at the overall picture of this company, the share price is good. It's a buy. The third one is Ebix, provider of an enterprise cloud e-commerce solutions for insurance, finance, and healthcare industries. It's considered a small cap in the software application industry. Market cap is a little over $870 million. We have revenues ramping up, assets well above the liabilities, with shareholders' equity trending up, and it's got consistent cash flows. Here, there's not a lot of analyst coverage, which is good and bad. Good in that when analysts start discovering this company, it will get a lot more attention and the price may go up. The negative side of low analyst coverage is you don't have a lot of votes. The P/E ratio is relatively low here, 10 for a software company in a tech sector. I think that's low. 10 is below its 16.03 past 5-year average. One thing I noticed is the share price doesn't really reflect the fundamentals. We've got nice trending revenue, a nice balance sheet, and consistent cash, and yet the share price has been kind of trending down. So there's a bit of a mismatch between the two. But look at the overall picture. It seems like a really good buy and a good value for your money. Yeah, so that one buy recommendation also has a price target of 75, which is 170% upside. So that's pretty crazy. This one is probably going to be a patience game, but when it does get noticed, the price of this stock should ramp up. So there you have it, folks. I hope the video was useful for you. If you liked it, give it a thumbs up. If you have any questions or comments, you can leave them in the comments area of the video. If you want to book a one-on-one with me, it's free for a limited time. You can do so. You'll find a link to my Calendly in the description of the video. Take advantage of it because it's free for a limited time. I've got more videos coming, so make sure to subscribe to my channel and hit the bell button. You'll be notified whenever I upload new content. Thanks for watching today, guys, and we'll see you real soon.